Choosing among investment alternatives. It is important to take a closer look at the universe of investments and markets where investing takes place. Understanding how markets work, how different investments work, and how different investors can use investments is critical to understanding how to begin to plan your investment goals and strategies. You normally use the money markets to save surplus cash for the short term. Investing is primarily about using the capital markets to invest surplus cash for the longer term. As in money markets, when you invest in the capital markets, you are selling liquidity. And the capital markets develop as a way for buyers to buy liquidity. And there are two primary methods that have evolved into modern times, and these are the bond markets and the stock markets. Fixed income. Generally classified as money market instruments such as banks, certificates of deposit, repurchase agreements, among others, and capital market instruments such as commercial papers, corporate bonds, and government bonds. A bond is a loan to a corporation, the government, or a municipality. Therefore, in its books, it's considered as a debt. So bondholders receive periodic interest payments called coupon payments, and the principal is repaid at maturity, normally within 1 to 30 years, depending upon the issuance date. Bondholders can keep the bond until maturity and earn all the coupon payments as well as get paid by the bond issuer based on the bond's par value, or what we call the face amount. Bondholders can also sell it to another investor before maturity, but the coupon payment stops upon the sale of the bond by the original investor, and the bond proceeds may either be a discount or a premium from the original purchase price, depending upon prevailing interest rates. Equities. Equity capital is provided by stockholders who buy shares of a company's stock. Stockholders are owners and share in the profits or losses of the company. A corporation is not required to repay the money obtained from the sale of stock, and a corporation is under no legal obligation to pay dividends to stockholders, and they may instead retain all or part of the earnings. And there are two basic types of stock, the common stock and the preferred stock. Buy low and sell high is what the investor has in mind when he buys stocks. Stock prices fluctuate depending upon the investor's perceived valuation of the stock, which is based on the company's financial performance and the prevailing global and local macroeconomic conditions. If a stock is undervalued and its price-earnings ratio is low, then the stock has a high rate of return and there will be buying pressures which will push prices up. On the other hand, if the stock is overvalued and its price-earnings ratio is high, then the stock has a low rate of return and there will be selling pressures which will push prices down. Mutual funds. Shares of an investment company, which is referred to as a mutual fund, are bought based on the current net asset value per share, and this refers to NAVPS, which is equivalent to the total assets minus the total liabilities, all over that of the outstanding number of shares. Investors' money is pooled together with other investors of the same mutual funds, managed and invested by a professional fund manager. While past performance of a fund will determine how good the fund manager is, it is not guaranteed that the same fund performance will happen in the future. And based on the fund's objective, mutual funds can be invested in a wide range of conservative, such as bonds or fixed income, to balanced, such as bonds and stocks, to volatile instruments, mostly stocks or other currencies combination. Diversification is provided since risk is spread among co-investors of the fund, and for a small amount of investment, the investor has a proportionate share of all investments made. Financial needs of the investor should be consistent with that of the fund's objective. Be aware of fees and the minimum holding periods depending upon the different funds chosen. Real estate. The goal of a real estate investment is to buy a property and sell it at a profit. Nationally, 3% appreciation in price a year is the average. However, decreases in value are also possible. Location is the most important consideration. So before you buy any real estate property, ask the following questions. Is the property priced competitively? What type, if any, of financing is available? And how much are the taxes? What is the condition of the buildings and houses in the immediate area? Why are the present owners selling? Could the property decrease in value? Investments in real estate provide relatively good returns over time. However, when a financial need arises and you need to unload it, it will take some time to liquefy such an investment. Foreign exchange. The forex market is a highly liquid with lots of volatility since large volume of currency exchanges are transacted among financial institutions, governments, corporations, and are open 24 hours around the world. Foreign exchange, or what we call forex transactions, provide the conversion of one currency to another, facilitate the exports and imports of goods, which results to a financial or credit exposure with another party or country of origin. Investing in currency pairs, for example, the US dollar versus the euro, means taking a position for or against that base currency, which is the first in the currency pair, will appreciate or depreciate in value compared to the counter currency, which is the second currency in the pair. Margin trading, on the other hand, refers to investing in a minimal amount compared to the real value of the forex contracts. This means that if there is a 10% margin exposure in a currency pair and a buying position was taken, then a 10% rise in the price would mean that the investor will have 100% profit on his position. On the other hand, if there is a 10% margin exposure in a currency pair and a selling position was taken, then a rise in 10% in the price means that the investor will have a 100% loss on his position. Derivatives. Structured or derivative securities is a contract or payment agreement whose value is taken from the value of the underlying asset. Reference rate or index are contracted or traded. An example of this would be swaps, and swaps are contracts in which two parties exchange securities to their advantage. It allows parties to exchange cash flows within an amount of time for purposes of hedging risk, which results from fluctuating interest rates and foreign exchange rates. The change, maturity, or what we call bonds, and the quality of issues, we call stocks or bonds, respond to changes in an investment objectives. Exchange asset at a predetermined date and price, and one trader pays at a fixed rate while the other pays based on a variable rate. It's unregulated and still solid contracts despite the default risk. One type is what we call the interest rate swaps, and it's hedged against interest rate fluctuations. Forwards, on the other hand, is an agreement between seller and buyer in trading of a certain quantity of assets at a certain fixed price or later date. No money is exchanged at the beginning, but you are locked in purchase without incurring direct costs. It's basically used for hedge risk, and it takes away uncertainty regarding prices. It's not publicly traded, not regulated, and there could be a default risk. Examples of forwards are what we call the foreign exchange forwards. The underlying asset is the currencies, and the trade between different currencies at a certain price as well as on a future date. Another is what we call the non-deliverable forwards, which are cash-settled short-term, no physical exchanges of currencies, and these are currencies that are usually non-convertible or thinly traded. This can also be cash obtained from profit accumulated from computing value of the currency based on contract rate and prevailing reference rate. Futures, on the other hand, are hedging mechanisms for producers or buyers of soft commodities, such as agricultural products, which are the likes of soybeans, sugar, rubber, or hard commodities, which are metal products such as gold, silver, copper, among others, or it can even be oil or energy products. Therefore, future contracts reflect the prices and volume of the commodities, which are determined or negotiated during the current month for a specified future month. The position taken with these future contracts will assure the sale or purchase of these commodities at a fixed price, no matter where the price may be in that specified future month. When the specific future month becomes current month, or what we call the spot month, and you still have the futures contract, then you will deliver or receive the physical goods that you bought. Margin trading is deployed in the futures market and can have several results like foreign exchange transactions. If you do not want to settle at a loss since it has gone against your current position, then you will have to raise additional funds to maintain the same margin position, including the current loss. Options are underlying assets, usually stock or an index. It's an obligation on the seller. The buyers are given the right, but not the obligation. If a buyer does not go through with the contract, the buyer loses money to pay for the contract. Example are that of currency options, wherein the underlying asset are different currencies. For caps and floors, caps refer to when the users go for a short position. A short position means that the user borrows an asset and sells it, might be able to replace the asset for a lower price. Using the combination of purchase call option on asset, it provides insurance for short positioning. Floors, on the other hand, refers to hedge against falling asset prices. It becomes an insurance for the asset and the use of a put option on said unit. Other speculative investments. A speculative investment means it's a high-risk investment made in the hope of earning a relatively large profit in a short time. Typically, these are speculative investments that includes coins and stamps, precious metals and gemstones, antiques and other collectibles, among others. In summary, while knowing now the different investment alternatives, we get to see that the ways that capital can be bought or sold can only be limited by the imagination. When corporations or governments need financing, they invent ways to entice investors and promise them a return. And over the last 30 years, has seen an explosion in what we call financial engineering, the innovation of new financial instruments through mathematical pricing models. This explosion has coincided with an ever-expanding powers of the computer, allowing professional investors to run millions of calculations involved in sophisticated pricing model. The internet also gives amateurs instantaneous access to information and accounts. And much of the modern portfolio theory has spawned these innovations. The idea of using predictability of returns to manage portfolios of investments is based on what we call an infinite time horizon, looking at performance over very long periods of time. And this has been very valuable for institutional investors such as pension funds, insurance companies, endowments, foundations, and trusts, since it gives them such chance to magnify returns over their infinite horizons. However, for most individual investors, most portfolio theory may present too much risk or just be impractical. Individual investors don't have an infinite time horizon, and you only have a comparatively small amount of time to create wealth and to enjoy it. Therefore, for individual investors, investing is a process of balancing the demands and desires of returns with the cost of risk before time runs out.